to our discussion on portfolio risk and return. This lecture corresponds to reading 53 in the CFA Level I 2011 curriculum. So in the last lecture we talked about this concept of the capital allocation line, and we are now going to draw a distinction between the CAL and what's called the capital market line. First, a quick review of the capital allocation line. Every investment advisor might have a different view of the market, and hence he will come up with a slightly different efficient frontier. So there will be different efficient frontiers for different investment advisors. And since there will be different efficient frontiers, there will be different capital allocation lines. So if you recall, we had our risk or sigma on the x-axis, our expected return on the y-axis, and for a given investment advisor, based on the market returns of various investments and based on the correlations, he would come up with this Markowitz efficient frontier. And then remember, this efficient frontier was based only on risky assets. We then said that if we now are allowed to use the risk-free asset, and let's say that this is the risk-free rate over here, then the capital allocation line represented this straight line which is tangential to the efficient frontier. So this is the CAL. Now if this represented the efficient frontier for investment advisor A, or this is what A comes up with, then this is the capital allocation line for advisor A. Now a different investment advisor might have a slightly different efficient frontier. So he might have an efficient frontier that looks like this. So he will then have a slightly different CAL. So his CAL will now potentially look something like that. So this is the CAL for advisor B, and so on. So essentially we can have different capital allocation lines for different investment advisors. So that covers this point. Now if we assume homogeneity of expectations, this means that we are taking a leap of faith and saying that all investment advisors have the same view of the market, they have the same view of expected returns, the same view of the correlations between different assets. Then there will only be one efficient frontier and only one capital allocation line. That single capital allocation line which every investment advisor comes up with is called the capital market line, or the CML. So you need to understand this term. So essentially then the CML is a special case of the capital allocation line. And students who first learn about the CML and then are taught about the capital allocation line will sometimes hear the phrase that the capital allocation line is an operational version of the CML. So the CML is a theoretical construct, but a very important theoretical construct where we are assuming homogeneity of expectations. When we don't have homogeneity of expectations, then we have multiple capital allocation lines. So another important, so that covers the CML. Another important concept is that of the market portfolio. The market portfolio is the point where, so we call this M, this is the point where the efficient frontier is tangential with the capital market line. So we had talked about this in the earlier lecture, but make sure you understand this definition. So the market portfolio theoretically is a combination of all risky assets, but from a practical perspective we usually use an index such as the S&P 500 as a proxy for the market portfolio. This is a long theoretical discussion, but I don't think it's necessary to get into it for the exam, for the level 1 exam. All you need to realize is that as an approximation for the market portfolio, we generally use an index such as the S&P 500. So now let's look at the capital market line in a little more detail and see the risk return characteristics of this line. So essentially what we are going to look at is, for a given portfolio, riskiness given on the x-axis, expected return on the y-axis. If you recall, this line will pass through the risk-free rate over here, and it will also pass through the market portfolio, where the riskiness of the market portfolio is given by sigma m, and the return on the market is given by, let's say, Rm. The equation for this capital market line then becomes the the return on a portfolio, or the expected return on a portfolio, is equal to the risk-free rate plus, so risk-free rate is our y-axis intercept, plus the slope of this line. So the slope of this line, if you look at this point, the slope is the change in y over change in x. The change in y is your expected return on the market minus the risk-free rate, and the x is simply sigma m. So our slope becomes Rm, return on market, expected return on market, minus risk-free rate, divided by sigma m, which is the riskiness of the market, multiplied by the x variable, which is the sigma of the portfolio. So this actually is exactly what we saw in the last lecture on the CAL, and essentially, since CAL and CML are more or less similar, we have the same equation. Notice that as the riskiness of a portfolio increases, so riskiness goes up as we move right on this axis, then the expected return also goes up. So not surprisingly, there is a positive relationship between risk and return. This CML can be broken into two parts: the part before the market portfolio and the part after the market portfolio. So let's understand these points. This point, let's call this point 1. At point 1, our portfolio consists purely of the risk-free asset. At point M, our portfolio consists of purely the market portfolio that I have talked about earlier. And between point 1 and point M, we have a combination of the risk-free asset, which is, say, the T-bill, and the market portfolio. When we invest in the risk-free asset, we are actually lending money to the government. So the risk-free asset is nothing more than lending to the government. So this part of the capital market line is called the lending portfolio, because part of our money is being lent to the government, the other part of our money is being invested in the market portfolio. So this part is called the lending portfolio. Now, how do we get a return above the market return? This part of the CML line, which is above the point M, or above the market portfolio, the way you can get a return above the market portfolio is by constructing a borrowing portfolio or a leveraged portfolio. So this part of the CML line is called a borrowing portfolio, because you are borrowing from somewhere. Let's say, actually doesn't matter where you are borrowing from, but essentially you are borrowing money and using that borrowed money to invest in the market. So as you can imagine, that's clearly more risky, and that also gives you a higher return. So the points to the right of the market portfolio are referred to as borrowing portfolios. A simplistic assumption over here is that the lending rate, which is, say, your T-bill rate, is the same as the borrowing rate. Because of that simplistic assumption, our CML is a straight line. Now on this slide we are looking at what happens if the borrowing rate and the lending rate are different. So again, this is our risk, this is our expected return. The point where we see a kink is our market portfolio. So remember, this was our lending portfolio, and to the right is our borrowing portfolio. Now typically our borrowing rate will be higher, so typically our borrowing rate will be greater than the lending rate. So since our borrowing rate is higher, the slope of the CML after the market portfolio, which means in the borrowing region, is going to be lower than the slope to the left of the market portfolio. The intuition is straightforward. When we are to the right of M, we are borrowing at a relatively higher rate. So for every additional unit of risk that we take, the additional return is lower relative to when we are in this side, on this side, left of the market portfolio. So from an exam perspective, we don't need to get into too much detail. If you really want to know the formulas, then the formula is actually given in the curriculum, but very simplistically, to the left of the market portfolio, this slope and hence this formula is exactly what we saw on the previous slide. And on the right, instead of using the earlier risk-free rate, we use the risk of borrowing to the right of the market portfolio. So let's continue talking about risk in a little more detail. So risk, broadly speaking, is broken into what's called systematic risk and non-systematic risk. Systematic risk is the risk inherent in a financial system. So if you take the US markets, for example, when you invest in a diversified portfolio consisting of, let's say, the S&P 500, clearly you are still taking some risk, because even an index fund based on the S&P 500 will be going up and down. So there will be variability in the returns over here. So that risk is referred to as systematic risk. So if the overall interest rates in the economy go up, that will have a negative impact on the stock market or the assets in general. So that's an example of something that caused systematic risk. If the overall US sovereign debt is downgraded, as happened recently, that again would be an example of something that creates systematic risk. Non-systematic risk, also called non-systematic risk, is the risk that is associated with a given stock. So if you simply invest in shares of General Electric, and there is an issue related to General Electric where, let's say, that the CEO suddenly resigns unexpectedly, so clearly the General Electric stock will head downwards. So there are risks associated with this particular investment. Those risks are referred to as non-systematic risk. Non-systematic risk is also sometimes called diversifiable risk, and systematic risk is sometimes called non-diversifiable risk. The implication being that that once you are fully diversified, the only risk that you face is systematic risk, and hence it cannot be diversified any further. A very popular picture in finance when we are talking about risk looks like this. So in here we look at the number of securities on the x-axis and the total risk on the y-axis. So the point being, if you just invest in one security such as GE shares, the total risk that you are taking is relatively high. As you add more securities to your portfolio, the risk comes down, and then it flattens out roughly at the 20 security mark. So this point over here, so this level of risk is referred to as the market risk, and this is your systematic risk. The risk, let's say if you've invested in two securities, the distance from here to here is the non-systematic risk, and our total risk, let's say represented by variance, is simply the sum of the systematic risk, which is this part, plus the non-systematic risk, which is, so the non-systematic risk is this part and the systematic risk is the bottom segment. So the total variance or total risk is equal to the systematic risk plus the non-systematic risk. Now, when we price assets and price securities in general, we only price for the systematic risk. The logic there being that non-systematic risk can be diversified away relatively easily, and hence the market will only compensate an investor for taking systematic risk. Okay, let's talk about the concept of return generating models. The whole point with return generating models is that we look at risks and risk factors and come up with how much return we would require for a given level of risk. The simplest kinds of models we use are called single factor models, and the most popular kind of a single factor model is called the market model. There is a tremendous amount of detail in the curriculum, but I think that the most important point or the fundamental point that you really need to know is what is a single factor model and what's a multi-factor model. So a single factor model tries to give us our expected return in using simply one factor. So let's just look at it with the market model. So the market model says that the required return on a given asset, let's say I, is equal to some alpha, which I'll talk about, plus beta times the return on the market plus a error term. So this is an example of a market model where we are trying to figure out what the return on a given stock is going to be. So what's the interpretation of alpha? The interpretation of alpha is what is the return we would expect on the stock if the market return is 0, and we can come up with this through analysis of past data, so do a regression on past data. So that's the interpretation of alpha. The interpretation of beta is the sensitivity of returns to different market returns. So all you really need to do is remember that this is the formula for the market model. This epsilon here simply stands for an error term. Multi-factor models are a little more complicated. So these say that the return on a given, or the expected return on a given investment, depends on several factors. Now typical multi-factor models are expressed like this. So we say that the return on an investment above the risk-free rate, so is typically going to be equal to let's say beta 1 or beta 1 f1 plus beta 2 f2 plus beta 3 f3 and so on. So this is a 3-factor model. We could also have 4-factor models, and essentially what these multi-factor models is saying, what these models are saying is the following: the expected excess return over the risk-free rate depends on several factors and the betas or the sensitivities of those factors. So typically the first and most important factor would be the return of would be based on market returns, and these are normally expressed. So the typical most important factor is the return on market minus the risk-free rate. So this is an example of the most commonly used factor. So in the US economy, for example, F1 would typically be the return on the market minus the risk-free rate in the US. And the beta is called sometimes the factor loading or the factor sensitivity. So this is telling us that for a given stock, how sensitive is the return to the market risk premium. Recall from earlier lectures that this term over here is also called the market risk premium. Now, just the way our return is dependent on the market risk premium, which is the first factor, the return could also be dependent on other factors such as size, market value to book value ratios, and so on. So these can be other possible factors, and then the betas would represent the factor weights, factor loadings, or factor sensitivities. So all those terms are used interchangeably. I really don't think there'll be, as in you'll be tested too heavily on this concept because it's covered in a lot of detail in level 2. All you really need to know is that multi-factor models are somewhat complex. They are used to come up with the expected return or the required return of an asset, and they depend on several factors and the betas for those factors. Note that all these betas will be different, and these are the betas associated, like beta 1 is associated with the first factor, beta 2 is associated with the second factor, and so on. If you feel you don't fully understand this material, it's not a very big deal. Don't get hung up over this.